In the annals of corporate fraud, few cases rival the sheer audacity and dramatic collapse of Wirecard. Once hailed as a European fintech success story, the company reached dizzying heights, momentarily surpassing Germany's oldest and most established banks in market value. Yet, beneath this glossy facade, a monumental deception was unfolding. By 2020, the truth would shatter Wirecard's image, a gaping hole in its balance sheet, nearly $2 billion in assets that simply did not exist. This revelation triggered an immediate collapse, but the scandal's most unsettling detail remains: the complete disappearance of one of its top executives, a man who, to this day, has never been found. Wirecard's ascent was nothing short of spectacular. From its humble beginnings, it quickly carved out a niche in digital payment processing, a sector poised for explosive growth. Its innovative solutions and global reach attracted investors, fueling rapid expansion. The company's trajectory seemed unstoppable, embodying the promise of Germany's technological prowess. This rapid growth built immense confidence, painting a picture of a forward-thinking, secure financial services provider, perfectly aligned with the digital age's demands for speed and convenience in transactions across the globe, an undeniable force in the evolving financial landscape. The year 2018 marked a symbolic pinnacle for Wirecard. In a moment that captured headlines across Europe, its market capitalization briefly eclipsed that of Deutsche Bank, a venerable institution with centuries of history. This achievement wasn't just a financial milestone, it was a testament to the perceived shift in economic power from traditional banking to agile fintech innovators. Wirecard's valuation signaled a new era, suggesting that digital disruptors could outmaneuver even the most deeply entrenched financial giants, reshaping the very definition of a leading financial entity on the global stage. It seemed to embody the future of finance, dynamic and unbound by legacy systems. At its core, Wirecard claimed to be a global provider of electronic payment transaction services and risk management. It facilitated online payments for thousands of merchants, processing transactions across various currencies and platforms. This complex, behind-the-scenes work was crucial for the digital economy, making it a seemingly indispensable partner for businesses worldwide. The sheer volume and complexity of these operations provided ample cover for illicit activities. Its services promised efficiency and security, attracting a vast client base who trusted their financial operations to Wirecard's seemingly sophisticated and reliable infrastructure, a trust that would later prove to be fundamentally misplaced. Even as Wirecard soared, not everyone was convinced. For years, skeptical journalists and short sellers raised red flags, pointing to inconsistencies in its financial reporting and questioning the legitimacy of its third-party partnerships, especially in Asia. These early warnings, however, were largely dismissed or aggressively countered by Wirecard itself, often with legal threats. The company's powerful narrative of innovation and growth, combined with its high-profile status, made it difficult for critics to gain traction. The mainstream largely ignored these crucial early signals, seduced by the promise of explosive returns and the allure of a rapidly expanding tech empire that seemed impervious to traditional scrutiny. Auditors are the gatekeepers of financial integrity, tasked with independently verifying a company's accounts and ensuring transparency. For years, Wirecard's audits were handled by Ernst & Young, one of the Big Four accounting firms. Their role was critical in lending credibility to Wirecard's spectacular balance sheets. The fact that the $2 billion fraud persisted for so long, under the watch of such a prestigious firm, would later become a central, damning aspect of the scandal. The failure to uncover irregularities raised profound questions about audit quality, oversight, and the very mechanisms designed to protect investors and maintain market confidence. The fraud centered on phantom assets, primarily through Wirecard's claim of holding large cash balances in escrow accounts with third-party partners, particularly in the Philippines. These billions of euros were supposedly generated from transactions processed for Wirecard by these partners. However, these accounts were largely fabricated. It was an elaborate shell game, where money that never existed was reported as solid assets, inflating Wirecard's financial health and convincing investors of its robust cash flow. The deception relied on the geographical distance and the perceived complexity of international financial arrangements, making verification seem cumbersome and unnecessary to many. Wirecard's scheme wasn't a simple one-off lie, it was a multi-layered tapestry of deception woven over years. It involved an intricate network of third-party acquirers, shell companies, and falsified contracts designed to obscure the true nature of its operations and inflate revenues. Documents were forged, accounts were misrepresented, and money was shuffled to create the illusion of legitimate business activity. The scale and duration of the fraud demonstrated a sophisticated understanding of financial reporting loopholes and a willingness to exploit them systematically, creating a labyrinth that proved incredibly difficult for external parties to navigate or unravel, even with dedicated scrutiny. The pressure mounted. Sustained investigative reporting, notably by the Financial Times, eventually forced regulators to act. BaFin, Germany's financial watchdog, and eventually prosecutors, launched a full-scale investigation into Wirecard's affairs. This was no longer just a distant rumor, it was a formal probe into a company at the heart of Germany's financial market. The stakes were incredibly high, not just for Wirecard, but for the credibility of German and European financial supervision. The deep dive into Wirecard's operations marked a turning point, signaling that the era of simply dismissing allegations was over, and accountability would finally be demanded. The breaking point came in June 2020. Ernst & Young refused to sign off on Wirecard's 2019 accounts, stating they could not confirm the existence of €1.9 billion, nearly $2 billion, in cash balances. This was the moment the illusion shattered. Wirecard admitted that these funds likely did not exist, leading to an immediate collapse in its share price. The company filed for insolvency, and its CEO, Markus Braun, was arrested. The $2 billion had, quite literally, vanished into thin air, exposing one of the most significant accounting scandals in German history and leaving investors stunned and betrayed by the sheer scale of the deception. Amidst the chaos and corporate implosion, one of Wirecard's most senior executives, Chief Operating Officer Jan Marsalek, simply disappeared. He was last seen in the Philippines in June 2020, just as the scandal broke wide open. Despite international warrants for his arrest and extensive efforts by authorities, Marsalek has never been found. His vanishing act added a layer of espionage and intrigue to an already sensational case, fueling speculation about his whereabouts, whether he was aided by powerful entities, and what secrets he might still hold. This personal disappearance became as iconic as the missing billions, a symbol of the scandal's enduring mystery. Marsalek's disappearance echoes historical enigmas, reminding us that individuals of immense financial power have vanished before. Consider Alfred Lowenstein, the Belgian financier who, in 1928, mysteriously fell from his private plane over the English Channel. Or the modern billion-dollar conman Joe Low, who lived lavishly before disappearing amidst the 1MDB scandal. These cases underscore a chilling reality. For some, the ability to make billions disappear extends to making themselves disappear too, leaving behind bewildered investigators and lingering questions about the true extent of their networks and influence, perpetuating an unsettling pattern of evasion by the ultra-wealthy. The Wirecard saga highlights a critical vulnerability. Even with advanced systems and regulatory frameworks, human governance remains the weakest link. As seen in the Web3 hacks of 2025, where $4.2 billion vanished due to human error and manipulation, complex financial systems are only as secure as the people overseeing them. The Wirecard fraud wasn't a technical glitch, it was a deliberate, human-orchestrated deception. This human element, the greed, the complicity, the willful blindness, allowed the fraud to flourish for years, proving that no amount of cryptographic primitives can fully safeguard against determined human malfeasance at the top levels of an organization. The Wirecard scandal exposed major flaws in European financial oversight, particularly in Germany. Regulators like BaFin were criticized for their slow response, their apparent initial bias against whistleblowers, and the fragmented nature of their investigative powers. The oversight system, designed to protect investors and maintain market integrity, proved inadequate against Wirecard's sophisticated fraud. The fallout prompted soul-searching and calls for significant reforms, acknowledging that the existing mechanisms were not robust enough to police the rapidly evolving and increasingly complex world of fintech, allowing a substantial lapse in investor protection that should never have occurred. Beyond the staggering $2 billion that vanished, the Wirecard scandal inflicted deeper, less quantifiable damage. It eroded public trust in financial institutions, regulators, and the auditing profession itself. Investors lost billions, employees lost jobs, and Germany's reputation as a reliable financial hub took a significant hit. The true cost extends to the pervasive doubt now cast over the transparency and accountability of other fast-growing tech companies operating in complex global markets. It became a stark reminder that the pursuit of rapid growth, if unchecked, can lead to devastating consequences, not just for a single company, but for an entire economic ecosystem. As years pass since the initial discovery, the mystery of Jan Marsalek deepens. Despite extensive international manhunts and numerous theories about his potential whereabouts, from Russia to Belarus, no credible trace has ever been found. His continued disappearance serves as a haunting epilogue to the Wirecard saga. It ensures the scandal remains an open wound, a symbol of accountability evaded, and a stark reminder that some architects of financial deception can seemingly melt away, leaving only questions and a vast void where billions of dollars once stood. The search continues, but with each passing day, the chances of finding him dwindle. The Wirecard scandal prompted urgent calls for reform. Germany's government overhauled its financial regulatory body, BaFin, granting it more powers to investigate companies, regardless of their financial license status. There were also commitments to strengthen audit oversight and introduce stricter corporate governance rules across the EU. Yet, the question remains, are these measures truly sufficient to prevent another Wirecard? The sheer scale of sophisticated financial fraud, often masked by digital complexity, challenges even the most robust regulatory frameworks, emphasizing an ongoing struggle to adapt oversight to the rapidly evolving global financial landscape. The memory of Wirecard casts a long shadow over the fintech industry and the broader financial markets. It serves as a potent reminder of the fragility of trust and the potential for even highly valued and seemingly legitimate companies to harbor deep-seated corruption. Investors and consumers are now more vigilant, but the sophistication of financial crime continues to evolve, making the battle against fraud an endless one. The incident underscores that while innovation drives progress, it must always be met with unwavering scrutiny and robust, proactive oversight to safeguard the integrity of our global financial ecosystem against future betrayals of trust. The phrase "vanished into thin air," popularized by Shakespeare centuries ago, perfectly encapsulates the Wirecard enigma. It implies a complete, inexplicable disappearance, a sense of wonder mixed with dread. For Wirecard, it wasn't just physical cash that disappeared, it was an entire corporate identity, a perception of stability and integrity. The idiom speaks to the baffling nature of such grand deceptions, where something so substantial can seemingly cease to exist without a trace, leaving behind only the ghost of what once was. It's a phrase born from magic, now chillingly applied to the most elaborate of financial frauds. The Wirecard scandal is a stark cautionary tale, a vivid illustration of how ambition untethered from ethics can lead to catastrophic results. It highlights the immense cost of deception, not just the $2 billion that disappeared, but the immeasurable damage to reputations, livelihoods, and the essential trust underpinning the global economy. As investigators continue to piece together the fragments of this complex fraud, the disappearance of Jan Marsalek ensures that the full story may never truly be known. The echoes of Wirecard will continue to resonate, a permanent scar on Europe's financial landscape, urging constant vigilance against the shadows of corporate malfeasance.